Welcome to our eSignal Weekly Forex and Futures Forecast. My name is Jay Norris. I teach trading at Trading University. First market we're going to take a look at will be the Australian US dollar. Aussie US dollar kind of limping along there, trying to move higher here. If we had to call where this market's going to go this week, we just have to stay steady to higher. I think it's appropriate we show you our RTT ratio. There you go. You can see that 25-day pattern is down, and that's the resistance you're looking at right there. So a little bit longer term trader, you'd be keen on watching for potential sell setups in that area. On the other hand, you start to get closes above that level, 79.65 or so, and we'd have to shift gears there and again look to be dip buyers. So that's definitely going to be the level to watch in the Aussie. Next market, dollar Swiss. As we said last week, if you like the dollar Swiss here above support near term, you got to love it at that intermediate term support just above 90 the figure, and that's where we're at too. Now we'll definitely be watching that levels in here where support already held to see if to see what transpires there. And again, the recipe is a simple one. You get buy setups, buy signals in that area, you want to go with them. On the other hand, if it makes a lower low and starts to get closes below support down there, you want to back off and see, because potentially you're going to move from being a dip buyer to a seller of rallies there. We don't want to get ahead of ourselves, so currently we're looking for support right around 90.75 or so. So we definitely like Swissy long term. Next market, the dollar index. Same story. You had support here, it didn't hold. We look for support now at that going back into the May low. And the big story last week was the U.S. Fed. Under past Fed chairmen and Fed officials, Treasury officials in the past, they tend to view the world, they tend to view different countries as competitive trading platforms. This Fed Chairman Yellen, she's a little bit different. She's siding with the IMF as far as wanting to put everything on hold until the other countries can catch up too. And she also wants to avoid the volatility that we started to see in treasury markets around the globe when the markets were accepting the fact that we're going to have higher rates over the last couple of months. You saw bond prices going down pretty quickly in the U.S. and around the globe. So in an effort to stave that off, to try to moderate that, and to ensure that the global economy can start to catch up with the U.S. economy, she agreed to put any rate hikes on hold. And that's the story right now, and that's why the dollar had a weaker week. But as we were saying all along, if we like it there, we love it down here. We think that you'd have to take a good look at those levels. If I had to call this market right now, I'd have to say steady to lower. However, you've got good support all the way, from the mid 92 handle all the way down to 90 the figure, 90 even. So definitely we want to watch those levels to see what happens. And the key is really going to be, can the U.S. economy continue to put up employment numbers, continue to put up the retail sales numbers that we finally starting to see in April and May. As always, the markets will be data driven. Coming into this week, I'd say steady to lower, steady to boring for the U.S. dollar, and let's keep an eye on these lower levels. Similar story in the euro. I think this euro short covering rally, it's got probably a little bit longer to go. When you break out the RTT ratio, when you break out our ratio, you could see, boy, that's a tough market for a day trader to go short. In fact, we've been doing pretty good on the long side just based on what's happening on those lower time frames. Here's our benchmark in the euro, and put up pretty good numbers. You could see that $30,000 in wins. We're halfway through the year there, pretty good. But if you go back all the way to April here, here's the dates, April 1. Look at that, April 6th right here. Hopefully you guys can see that. That was our first buy in the euro. So we've pretty much been on the buy side all along with our short-term day trading method here, and that's been paying off. So that's the value of just going along with the flow, right? Look at this, had a really good run here to start June, and these are all trades in the euro. Buy. So nothing wrong with taking advantage of those counter trend moves. And from our perspective, they're not counter trend moves on these lower time frames. Here's how we approach the market. We generally take 3 successive patterns and we trade along with the majority of those patterns. Clearly, all of them are up. All the short-term patterns are up in the euro. So we would look for a continuation of that. You look at the daily chart and it doesn't look like much, but when you look at our short-term trading performance, you can see steady gains, and hey, that's the bottom line. Look at the method's up quite nicely 6 months into the year. So you find something that works, you got to stick with it. So from a longer term perspective, yeah, we think there's still from an intermediate term perspective, we think there's still some upside in this overall, what we're still calling a short covering rally. And that from an investor standpoint, you want to be interested when it perhaps blows stops above 115 or so, and you start to get those higher time frame sell setups closer to that 118.5 level. That's going to be a level to watch long term to set up short. Short term though, from a day trader's perspective, we'll continue to take advantage of it on those lower time frames, just as we have. Pretty good short-term performance year to date. This is our Trading University's benchmark day trading method. You're looking at a 75% winning percentage. It's always a 1.4 risk reward. It's based on a $50,000 account. So you look at the performance. That's your P&L. So you have a positive P&L of $30,000 on a $50,000 account. You're looking at a 60% return halfway through the year. So pretty good. So there's definitely something to letting the data organize itself, trading along with those short-term patterns, right? Longer term here, similar story in the dollar. The primary pattern is still down in the euro, up in the dollar index. Nothing wrong with taking advantage of what's happening short term, but from an investor standpoint, we think you just be patient, maintain those long-term shorts from an investment standpoint, and look to potentially add to them when you get in that the 118 handle in the euro. Next market we'll cover gold. Gold, pretty good leading indicator from our perspective, and you look at it, it's pretty clearly you're in a bear market. That's the daily chart, you're in a bear. Look at the weekly chart, you're in a bear. There it is. Gold really been a heartbreaker for the gold bulls too, because look at it, gives you these it gives them a little bit of hope. It rallies, then it comes back down and resumes the downtrend. Right here, coming in this week, you're probably steady a little bit higher, but overall you're in a bear market. You have pretty good resistance, 1208 or so. We think that's going to be an excellent level to set up shorts in that market. Shorter term, right here, if you look at Thursday, you had a big update. Short-term shorts would have got blown out of there. You had to take some losses there as it ran the shorts out. On the other hand, all it really does from an intermediate term perspective is just give us another setup, give us a better level to set up shorts at. So gold, nothing has changed for us there. Long-term pattern of lower lows, lower highs, so that's a bear market. U.S. interest rates, that's what everyone's been keying off of. Interest rates finally started to back down there based on Yellen's positioning there, Yellen's overall philosophy that she wants to see not just growth in the U.S., but continued growth, and she really wants to see continued global growth too. She wants to see the globe catch up with the U.S. So we're looking at a Fed that bases its decisions more on the collective global economy than we've ever seen in the past. So that's going to be interesting for us. Bottom line here, short-term interest rates heading back lower, but you have good support overall. So calling this guy coming into the week, U.S. interest rates, you have to think steady to lower. So, as always, U.S. data, very critical. If you continue to see good U.S. data, the U.S. economy continue to put up good numbers as far as durable goods, retail sales, employment numbers, you'll definitely see interest rates stabilize. You'll definitely see the dollar stabilize also. My name is Jay Norris. I teach trading at Trading University. Thank you so much, and we'll see you next week.